You weren't supposed to hear this. And the fact that you're here right now means you've already stepped into a room most people don't even know exists. Because while everyone else was watching headlines scroll by, something far more dangerous was happening underneath the surface of the gold and silver markets. Something violent, something intentional, something that only makes sense if you understand who really controls money and, more importantly, how they control the human mind. This week wasn't chaos. It was choreography. And once you see it, you can't unsee it. If you want real financial truths they don't teach, hit subscribe and turn on notifications. You don't want to miss what's coming. Not because it's exciting, but because what's coming decides who survives the next reset and who gets erased by it. Gold and silver didn't just have a wild week. They were dragged through a psychological battlefield designed to flush out weak hands, scare off latecomers, and transfer real value from the impatient to the prepared. Prices didn't move randomly. They moved with intent. When gold crashed, when silver collapsed, when volatility exploded, it wasn't because the system was breaking, it was because the system was working exactly as designed. Here's what most people missed. Last Friday, the nomination of Kevin Warsh as the next central bank chief detonated a chain reaction. On the surface, it looked like a policy shift, a stronger dollar, a hawkish signal, a reason to sell metals. That's the story the media sold. But beneath that story was something far more important. Positioning was extreme, liquidity was thin, and the largest players in the world needed an excuse to reset the board, so they used one. The dollar surged, metals imploded, and decades of confidence in safe havens got tested in a single trading session. Silver experienced one of its worst days in living memory. Gold fell so fast it felt like gravity turned off and then slammed back on. Retail investors panicked. Stops were triggered. Margin calls cascaded. And right there in the wreckage, the real game began. Because when gold dropped below levels that were supposed to never break, it wasn't signaling weakness. It was signaling extraction. This was a liquidity event, not a trend reversal. The kind of event elites wait months for, sometimes years. The kind where they can buy real assets from terrified sellers at a discount while the media screams that the trade is over. Then came the rebound, sharp, violent, almost insulting in its speed. Gold ripped back toward $5,000 an ounce. Silver exploded upward nearly 8% in a single day, and suddenly the narrative flipped. Analysts started saying the sell-off was positioning-driven, that volatility was uncomfortable, that markets were finding balance. That language is important because it's designed to calm you down just enough to keep you participating while never telling you the truth. The truth is that this wasn't about macroeconomics. It wasn't about Iran. It wasn't about China. Those were just the masks. The real driver was fear. Fear is the most valuable currency on earth. It moves faster than money, spreads wider than information, and overrides logic every single time. Institutions know this. Whales depend on it, and every major wealth transfer in history has followed the same script. Inflate confidence, encourage leverage, then pull liquidity when positioning is maxed out. This week was a textbook example. Gold swung from around $4,400 to over $5,100 in days. Silver moved like a meme stock on steroids. These aren't normal price actions for boring metals. These are the footprints of massive leverage being unwound and quietly reloaded. And while retail traders were trying to guess the next candle, insiders were watching order books, derivatives exposure, and liquidity flows. Most people don't even know exist. Notice something else. Futures and spot prices didn't always move together. Silver futures fell while spot silver surged. That divergence matters. It tells you that paper markets and physical demand are drifting apart, that someone is losing control of the narrative, even if they're still controlling the price. And this is where the psychology gets dark. When prices crash, the system teaches you to associate pain with ownership. When prices rebound, it convinces you that you're late, that you missed it, that you should chase. This emotional whiplash keeps retail traders trapped in a loop of reaction instead of strategy. You're never positioned. You're always responding. That's not an accident. The media plays its role perfectly. During the crash, headlines scream panic. During the rebound, they whisper uncertainty. Never confidence, never clarity. Because clarity creates independence, and independence is the enemy of control. Look at how silver was framed. Worst day in decades. Then a massive bounce, then another collapse. Reduced liquidity, fading Chinese interest, choppy conditions. All technically true. All completely misleading if you don't understand timing. Chinese liquidity didn't vanish. It paused. Holidays matter. Capital flows slow temporarily. And that pause creates a vacuum where prices can be pushed around with less resistance. Smart money knows this. They don't fear volatility during low liquidity periods. They manufacture it. Gold, meanwhile, quietly stabilized on renewed haven demand. That phrase sounds comforting, but what it really means is that institutions started buying again once prices shook out weak holders. Haven demand doesn't show up at the top. It shows up after pain. Here's the part that should make you uncomfortable. While you were watching gold and silver, something else was happening in the background. Crypto liquidity was shifting, stablecoin issuance was adjusting, bond markets were twitching, and capital was rotating, not exiting. This wasn't money leaving the system. It was money changing hands. Silent wealth transfers don't look like crashes. They look like confusion. This is how resets happen now, not with one dramatic collapse, but with 1,000 sharp movements designed to exhaust you emotionally, to make you doubt your thesis, to make you sell the thing you understand for the thing that feels safe. But safety is an illusion when currencies are being debased in real time. Every dollar you hold is decaying, slowly, invisibly. Inflation isn't a spike, it's a leak. And gold and silver aren't just commodities, they're mirrors. They reflect how broken the money system actually is. That's why they're attacked so aggressively. That's why volatility is weaponized around them. The nomination of a central bank chief isn't just political theater, it's signaling. It tells insiders what kind of liquidity environment is coming, what kind of rules might change, what kind of narrative will be pushed, and they position accordingly long before you ever hear about it. By the time an article tells you prices are rising again, the accumulation has already happened. This is why retail investors lose. Not because they're stupid, but because they're late to information that was never meant for them. They trade headlines. Elites trade behavior. Think about it. Why would gold rebound so violently if the macro story truly changed? Why would silver whip around like a trapped animal if interest had genuinely dried up? It wouldn't. It would drift. It would die quietly. Violence means conflict, and conflict means opposing forces are fighting over price. One side needs lower prices to accumulate, the other needs higher prices to justify their positioning. And in the middle is you, watching candles, feeling your stomach drop, trying to decide whether to buy, sell, or freeze. That paralysis is the goal. This is the liquidity trap, when fear forces you out and greed pulls you back in higher, over and over, until your capital is gone or your confidence is broken. Crypto traders know this feeling well. It's the same psychology, just wearing a different costume. Whales dump into strength, scare retail into selling, then accumulate in silence. Later, when the narrative flips bullish again, they distribute at higher prices and repeat the cycle. Gold and silver are no different. They just operate on longer timelines and deeper psychological anchors. People trust them, which makes them perfect tools for manipulation. And here's the twist most people never consider. The system doesn't want you to hate gold or silver. It wants you to mistrust yourself, to feel like you don't understand markets, to believe that price movement is random, unpredictable, and only understandable by experts. That belief keeps you dependent. But when you zoom out, patterns emerge. Every major sell-off in real assets happens alongside a justification, a nomination, a war headline, a policy rumor, something loud enough to distract you from the positioning underneath. This week's wild swings weren't warnings. They were invitations. Invitations to panic, invitations to exit, invitations to hand over assets to players who think in decades, not days, and they accepted those invitations gladly. The warning here isn't that gold or silver are risky. The warning is that emotional investing is lethal. Fear makes you sell the bottom, greed makes you buy the top, and the media feeds both on demand. Ask yourself this. If gold is truly obsolete, why does every central bank still hold it? If silver is irrelevant, why does industrial demand keep rising? If real assets don't matter, why do elites never stop accumulating them? Because they understand something you're not supposed to. Real value doesn't shout, it waits. This is about more than metals. It's about seeing the system for what it is, a psychological machine designed to extract time, attention, and capital from the many and concentrate it in the hands of the few. Markets are just the interface. And once you understand that, price swings stop feeling random. They start feeling intentional, like messages, like warnings, like tests. The legendary ending to all of this isn't a prediction, it's a choice. You can keep reacting to headlines, letting fear and greed pull you around like a puppet. Or you can slow down, detach emotionally, and start watching what the big money actually does when things get uncomfortable. Because every violent week like this leaves clues behind about who panicked, who accumulated, and who understood the game. Here's my question for you, and I want you to answer it in the comments. During this chaos, did you feel fear, greed, or clarity? Be honest. That answer tells you more about your future than any chart ever will. Send this to someone who needs to hear it, especially if they think markets are fair, rational, or transparent. And if you want to stay ahead of the narratives instead of trapped inside them, subscribe, turn on notifications, and stay sharp. Because the next move won't be announced. It'll be felt.